In this video, I want to explore whether investing in gold is a hedge against inflation. At the moment, we see a spike in inflation in many countries due to higher energy prices. This has a knock-on effect on many other products, including food prices. Many people promise that investing in gold would be an effective hedge against inflation. Before we go into the data and do some exciting data analysis, we need to first understand what we mean by hedging. A hedge means that a certain risk doesn't affect you anymore. Put differently, if we want to hedge against inflation, we would hope that our hedge leads to stability. Hedging doesn't mean you outperform massively and you get very high returns. Hedging means stability. Now, this video goes into the nitty-gritty of analyzing the data. We start by getting the data for free because I like free stuff. Then we process the data first in Excel and later we move to Stata. If you're not familiar with Stata, I have a whole playlist where you can explore how Stata can make analyzing data fantastic. Then we import the data. We focus first on gold prices, then we need data on inflation, and we analyze the data using time series methods. In this video, I just stay at a very simple, very descriptive level of analysis. If you have any questions, as always, please leave a comment below and I will try to get back to you. It's important to note that all the data and all the code is available for free on my GitHub. The link is down below in the description. Also, I stress that the price data is available online for free, so you don't need any license, you don't have to spend any money. Because sadly, when it comes to financial data, very often you have to have a license to get access to the data. So the first data set, which is already open as an Excel file, that's actually a comma separated file, a CSV file to be precise. We have gold prices since 1978, and as you can see, we have monthly gold prices. Now, obviously, the euro did not exist throughout the whole period, but actually what happens here is it was backcasted, so that we have a period since 78, all in euro, and this is focusing on the spot price of gold. In this case, the idea is that I start investing 10,000 euros in 1978, December time, and I keep holding it, so it's a buy and hold investment strategy up to the current period. And as you can see, if we just look at the price data, we observe a quite promising performance. So the value of this portfolio goes up over time quite significantly, and we actually hit 100,000 euros at the end of this period. Now, the key question is that enough to beat inflation in the euro area? The inflation data comes from a different data set. So this was compiled by the World Bank. Again, this is backcasted. It goes back to 1960. Now, this again illustrates what happens a lot in practice when you do data analysis. You have different time series that have different frequencies. So in the case of the gold price data, we have monthly data, but here in the case of inflation, we only have annual data. So we have to try to match these different frequencies. So what we will do next is we obtain all the data in Stata. So we import from CSV files to Stata, and then we do some data merging and cleaning, and we have to make sure we can match the frequencies. First, you have to check whether your data uses any special formats. There are two different ways to do it effectively. So one way is simply to copy paste this one more time and then use here the paste special and only focus on values. So get rid of any data formats. So that's one way to do it. Or we can just mark our data, do a right click, go to format cells and check here the data format. So if it's a general format, that's fine. In most cases, Stata will be able to understand the data without any problem. We will discover very quickly that in this case, the date variable needs some further work because the structure is year followed by months. So that is a bit less common and we need to do some work on that. Another point to note is sometimes you have missing data and depending on your data provider, they might use some symbols like hashtag NA or something similar. These symbols cause problems when you import to Stata. So the best approach is if you have symbols instead of missing values to remove them first. Stata can deal with missing values if a missing value is simply an empty cell. So this will be perfectly understood by Stata as a missing value. So we checked the data. We should save the data ideally as a CSV, so comma delimited file. So that works best. We do the same for our inflation data. Now let's move into Stata. I already opened a Stata do file. First, I used a change directory command to go into my target directory where I keep all my data. So that's the first step. And now we use the insheet command to import the data. You don't have to use the insheet command. You can also copy paste into the data editor in Stata. However, if you have many data sets or very large data sets, I would not recommend that. All right, so now I write down the insheet command, insheet using the name of the file, and then I use the option clear. Clear removes all data in memory. This is just a precaution if you already have a data set open, otherwise it would complain. There are some redundant columns which I remove using a drop command, but you will see this now in a minute how that looks like. But it's just to tidy up. So you see additional variables are imported, but they're just empty columns, so they can be removed. Let me just do a browse command, look into the data. And as you can see, we have the gold spot price. So this looks numeric. The date will be a string and we have to work on this. So the idea now is to focus on the first 4 digits. In this case, you have to remember that Stata counts from 1. So it will be 1, 2, 3, 4, which of course differs from Python. Good, so that's the next task. We have to get the substring. We convert the substring into a year variable that is a numeric. So now we have done the extraction. So I just call this new variable st for a string. I use the substring command. I refer to date, which is my date variable. 1 is the starting point, and I go up to 4. So I include 4 positions for my substring. So this will extract the first 4 items in this case. Then I convert the string to a numeric using the dstring method, and I generate this new variable year. Finally, I drop the old variables which I don't need anymore. Let me just run this. And now you see that year is created, which looks fine, starting in 78 and going all the way up to 2022. Of course, now we have duplications because we have monthly data, but monthly data doesn't really help us much because we can't match monthly data with annual data. So now we have to think how we deal with the monthly frequency. There are different ways to do it. One way is to focus only on 1 month and assume that you always invest in one particular month. The other assumption would be that you average the price. So I think it's more common to use a price average. So now we have done the following. We first sort by year. You have to always sort before you use the by command. You can also use the by sort command, which combines both. Personally, I like to separate the two. It's easier to read the code. So I sort by year. Then by year, I generate the average gold price. I call this gold. And then I use the mean function on the original gold spot price. I also include a counter, so within each and every year I count observations. This is helpful to identify duplicates because once I count to 2, I know that there are 2 or more observations per year, but I just have to have 1 in the end. I tidy up, so I drop the old variable, I use some labels, which is always a good idea. I remove the duplicates using the keep command, so I only keep if the count is equal to 1, which means I only look at the first occurrence in each and every year. I then drop later my count variable and then I sort my data, which is important because I use the year as an identifier to merge the data sets later. I save the data as a DTA file. I use the replace option because I might run this script several times, so I might create the same name for the file several times. I want to make sure that I replace any existing files. In the end, I do a line chart just to have a little look. And here we are. We have our gold price performance, which actually looks quite impressive. And it's all now organized and ready to be merged later. Now we move to inflation rates. Again, I give you some more details about the data set. I use the insheet command and I use this file name. I use the clear option to get rid of all the data in memory. So when we run this, we have now our new data set loaded. As you can see, we have the year, which is a numeric, and we have the inflation rate. The inflation rate is here expressed as a percent, so it's 1.74%. I could divide this by 100. I think it makes the calculation a bit easier, but that's a matter of perspective. So what I do next is I adjust the rate. I call this now inflation or inf, which is easier. I use a label for the variable. I drop the original variable. I sort by year. This is important before merging. And then I use the merge command. Yeah, so you see it's merge. I merge based on year. That's my identifier using the gold DTA, so the gold price data which I saved before. When you use the merge command, it also creates a merge variable. I don't necessarily have to look at this right now because it's in this case quite obvious, so I just drop it. And then I save my completed data in a new file, which I call final data. So now we have merged the data. So we have the gold price starting in 78 and we have inflation going back to 1960. Of course, we don't need the data here. So now the idea is to calculate the real performance of my gold investment. So we could indeed take the 10,000 euros and we then do inflation adjustment. There are different ways to do this. So what I do is I will create another index or multiplier where I see the impact of inflation directly on 1 euro, and then I can multiply this index with my gold portfolio to get the real value of my portfolio. And then we can see how we perform if we consider inflation. In terms of which inflation rate to use, that's again a matter of perspective because we have here annual data. In our gold performance measurement, we use averages. I use the previous year inflation rate as my measure to adjust the current prices. Again, it depends on exactly how the timing will look like, but that's a matter of preference. The benefit of doing this is I get some assessment for 2022. Yeah, so because here I have no information about the inflation rate. So you see, I save the data after doing all the merging, and then I open the data again in line 77. Why do I do it? Because very often actually I separate the data work and my data analysis. So I keep them in separate do files. If it's a small project, I might put it into one file, like in this case. But very often I would like to start running my analysis from here. Otherwise, I spend lots of time redoing my data work, which is of no use really. So here I construct this index or multiplier. I start in 78. This is when we have our gold price data with the value 1, and then I use the inflation rates. I refer to the previous index in the previous year, so this is why I use in rectangular brackets underscore n-1, which refers to the previous observation, and I use the previous inflation rate to make my adjustment. I use here the if statement that I only replace the index if the index is missing, otherwise there is a danger that I might overwrite my initial index position. Then I use a label for my index, and then I simply multiply this with my gold price portfolio, and I obtain a portfolio value in constant prices basically, or a real valued portfolio. Finally, I do a line chart and we have a little look. Let's head first into the data set. So now we have here the index construct, and you see quite strongly the impact of inflation. The value drops quite significantly. Actually, once the euro was really up and running, inflation really calmed down. So in a way, it certainly helped to reduce inflation, apart from the last period. And here is the real value of my portfolio. And now when we look at the line chart, then it tells you something about this investment strategy. So first of all, to note, it's not a perfect hedge by any means, because you have periods where you significantly underperform and you have periods where you significantly outperform. So all in all, it's not really a very convincing inflation hedge. So I would be very cautious to argue that investing in gold is the best idea to hedge against inflation. There's much more to say from a finance perspective, in particular if you want to do it, how to do it effectively, because certainly buying physical gold is the worst ever thing you can do, because you have very high transaction costs. You have to consider how to store this gold physically and so on. Any additional costs will of course reduce your performance. Good, I hope you had fun and I'll see you next time.